Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Micron stock so we can determine if it's a buy or a sell. Micron Technology is a semiconductor company that makes chips for the computer memory and computer storage industry. Some of the areas they work in are dynamic random access memory, also known as DRAM. They also make chips for flash memory and USB drives. The company is headquartered in Boise, Idaho, and was founded in 1978. Let's get started with the model. This is a large cap company, 67 billion market cap. They're trading at $61 a share, and they have 1.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They didn't really have any free cash flow in 2020, then it jumped way up to over $3 billion in 2022. There was great demand for semiconductor companies in 2022. Then it did drop off in the trailing 12 months. Their free cash flow is negative $2 billion. So that's definitely not a good sign if you're investing in this company. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that blew up to $8.7 billion in 2022, dropping to $1.6 billion in the trailing 12 months. The last time the company reported was 2/28/23. So their fiscal year is a little different than most companies. Most companies, their fiscal year is from January to December. I think their fiscal year is September 1st to August 31st. Revenue is the sales for the company, and that grew from 21 billion to 31 billion, but dropped off in the trailing 12 months to 23 billion. Let's look at the capital structure. 50 billion of equity, 7.5 billion of debt. They're 87% equity, 13% debt. And they could pay off all the debt with the cash on their balance sheet and still have 1.8 billion of cash left over. The WACC I used was 11.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 40 billion. We discounted those numbers back to today's new weighted average cost of capital, and we get a value of the company of $33 billion. We divide that by 1.1 billion shares. And we get a calculated stock price of $30. They're trading at 61, so they're trading at a 101% premium. It's a sell according to the model. The website Simply Wall Street has them at $39. They're also saying they're overvalued. 22 analysts priced this stock, and the average price target is $70. The low is 45, the high is 100. This is where the stock has been trading since 2002. So you can see it got really low back in 2010, 11, 12, 13, below $10 a share. And I remember doing a video on this company in 2020 when I first started my channel, and it looked amazing, the company. And I said they were really undervalued at that point, and the stock really shot up. It hit about $100. It has come down quite a bit since the peak, but still trading a lot higher than what it was before 2019. So if you didn't buy the stock between 2003 and 2020, I'm not sure if you could really ever make much of a profit on this company. It is possible I'm wrong and the stock does go back up to over $100, but that seems pretty unlikely. It looks like they did start paying a dividend in 2021. We'll look at that in a little bit. They started out with a 10-cent dividend in 2021, raised it to 12 cents. That's a yield of 0.75%. That's 0.75%. Which is 31% of their net income, but we can't look at their dividend over free cash flow since they have negative free cash flow. They might be investing a lot in their business, that's why they have negative free cash flow. Remember, free cash flow is cash flow from operations minus capital expenditures, and cash flow from operations is net income converted to cash. There are 62 companies in the same industry as Micron, and if Micron has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they are spending a lot in CapEx, nearly $11 billion in the trailing 12 months. That's why they have negative free cash flow. The idea is the investment in CapEx will lead to greater free cash flow in the future. They have a really good debt to equity ratio. Their yield is about average. They generate negative free cash flow. Intel is the worst at negative 10 billion. They rank 9th in market cap of all the companies. They don't have much debt, so they have a good price to book ratio. They have a really good price to sales ratio. They have a poor PE, and we can't look at their price to free cash flow. They do generate lots of revenue for the size of the company. but they're getting smaller. Their 5-year annual revenue growth rate is -2%, and they do have a really small ROA and ROE. So to summarize, I have them trading at a 101% premium. I rank their free cash flows 3 out of 10, their revenue 5 out of 10, and their ratios 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.